This conference will now be recorded.
Very nice message.
A very special gift. Two beautiful, magnificent, peregrine falcons. He handed them over to the man who was expert in training falcons. After a couple of months, the trainer informed the king that one of the two falcons was doing really well, flying majestically, soaring into the heights of the sky. But the other one, it had not moved at all from its branch from the very day that he had started training there. The king brought healers and sorcerers from all over the place to try and get the falcon to move. But the bird just wouldn't fly. Having tried everything he could, the frustrated king said to his minister, maybe we need someone more familiar with nature, someone who understands animals and birds. I think only such a person can solve this problem. Go, look for someone like this from the countryside and assign this task to him. The next morning, the king was thrilled to see the second falcon soaring high above the palace gardens. Delighted, he called his minister and asked him to get the doer of this miracle to him. The minister brought a simple farmer to the king. The king asked the farmer, how did you make this falcon fly? The farmer replied, it was very easy, Your Royal Highness. I simply cut the branch on which the bird was sitting. We are all created to fly, to live by the incredible potential that we have all been invested with. But often we sit on our branches, clinging to the things that are familiar to us, remaining stuck in our comfort zones, not willing to venture out, not willing to take risks. The possibilities are endless, but for most of us, they remain undiscovered because we continue to conform to the familiar, to the comfortable, to the mundane. So, for the most part, our lives are mediocre instead of exciting, thrilling, and fulfilling. What is the branch that's holding you back from flying high? What's the fear that's stopping you from taking the risk? What is the weakness that's inhibiting your growth? Unless we cut off the branches we are clinging to and free ourselves, we can never take off, reach newer heights in our life. What are you waiting for? Cut the branch and take your flight.
Welcome. I don't know if you can resonate with this, but I can tell you I can. Only when you start giving up things which are holding you back, that is where your real growth comes in. Right? So that is why sometimes it's said you have to throw away a lot of emotions as parents, as children, if you want to look for the real growth. Welcome, welcome, welcome to the last theoretical session of our batch. In reality, the journey begins today. The responsibility starts from today. That's the reality. Right, so first revision. We did a lot of strategies yesterday in the previous class. So time to revise. Bull call spread. when you're bullish. So I showed you how to build up a momentum strategy with the help of PROC and ATR percentage. When there is an extraordinary movement, you will create +1, -1. So remember my words. When this class is over, bull, you are bullish, call, difference between the two spreads, and spread is the difference between the legs, and the call is a medium which you are using, +1, -1, right? So +1 higher premium, -1 lower premium. So let us draw this graph one more time. Strike A, call your buying. Strike B, call your selling. Right? Bull call spread. Same underline, same expiry, same number of options. Bull put spread. -1, +1. Higher premium put, I'm selling. I'm bullish. I'm using put as a median. And the spread is a difference between two contracts. -1, +1. Higher premium put I'm selling, lower premium put I'm buying. Same underline, same expiry, same number of options. One more time, let us draw this. When I'm selling a higher, it is like this. Lower, it is like this. So if I do it together, it's like this. Bull put spread. Bull call ratio back spread, -1 +2. Yeah, depending Manasda, you can use both weekly, monthly. -1 +2. I'm extremely bullish, 20 to 22 days for expiry. In very quick time, maximum 4 to 5 days. So difference between the premium, maximum loss is the strike B, where I have bought 2 calls. From there, unlimited profit if the market goes up. Small loss if the market goes down. The biggest loss will be in the range if the market remains in the range. The biggest disadvantage is the theta loss in this strategy. Right? What did I tell you? Gap down. Big gap down. And from there, either if the market reverses in the next 20-25 minutes or at the close of the day. Now we come down to the bearish strategies. Bear put spread, +1, -1. 20 to 22 days, Manasda for expiry. Higher premium, lower premium. Right? Same underline, same expiry, same number of options. Bear put spread, +1, -1. So when I'm buying a put, it's like this. Strike A put I have bought, strike B put I have sold. Bear put spread, limited loss, limited profits. All right? Now with the second one, I'm bearish, but I'm using a call. Bear call spread, -1 higher premium, +1 lower premium. I'm bearish, I'm selling a call of a higher premium. I'm buying a call of a lower premium. right? Bear call spread. When will I do this bear call spread? When did I teach you? In normal case, you're going to do a bear put spread. When will you do a bear call spread? When you know the IVP is greater than 65, you will sell a OTM call and you will buy a FAR OTM call. Do you remember this? Great. Same underline, same expiry, same number of options. -1 + 1. Bear call spread. Now you come down to the last one. Bearish put ratio back spread. You're extremely bearish, 20 to 22 days for expiry. You're selling one put in the money. You're buying two puts out of the money or at the money. -1 higher premium, +2 lower premium. Do you remember this? You are extremely bearish, or the market should not stay there. In case if the market falls, you make money. In case if the market goes to the opposite direction, your loss is minimal, but the maximum loss is in a predefined range. Your loss is defined. In a predefined range, your loss is defined. Theta loss is the biggest problem with this strategy. So that is why we are doing when there are minimum 20 to 22 days for expiry, as well as we are not holding the position for the next 4 to 5 days. Is this clear? Good. Non-directional strategies. Butterfly, +1, -2, +1. +1, -2, +1. When I know in the middle of the range that this is the range, this is the butterfly. So as we discussed yesterday, we are expecting 16,000 expiry. So I'm selling two calls of 16K. I'm buying one 15,850. Buying one 16,150. The distance between strike A and B should be the same between the strike B and C. So the advantage is that if in a narrow range near to the expiry, if we can get the direction as well as the range correct, we are going to make money. If we can get the direction and the range correct, we are going to make money. Am I making sense? Vada pav. Right? Good. Whether I make a butterfly with a call or whether I make a butterfly, Kuldeep said that comes with experience, seeing the option chain, seeing the chart. That I can clearly, as I showed you the option chain yesterday, 16,000 is a strong resistance. Markets are bullish. We saw a lot of charts which showed that the markets are bullish. So we know that if the market goes up around 16,000, there can be strong resistance. So that is why if the market stays at that level, it is going to be very useful for us. Am I making sense? use of charts, use of put call ratio, use of open interest, global markets, combination of everything. Long put, whether I do a butterfly with the call, whether I do a butterfly with the put, the results are the same. Manas, the butterfly you can hold till expiry. If it remains in your range, you can hold it till the expiry. There is no point of cutting your trade. Only when it moves outside your range, you can cut your butterfly. Am I making sense? Now we come down to Condor. Limited risk non-directional. It's a variation of the butterfly. What is the difference? The second and third strikes are different. In the butterfly, they are the same, right? So you get a bigger and a wider range. So it is something like this. A, B, C. The maximum profit is between the second leg and the third leg, right? Again, range bound, near to the expiry, with the expectation. Anything you can use, Siddharth sir, there is no specification. You can use a call or a put butterfly. There is no problem. That is what I said exactly. No difference. Purpose is the same. The result will be the same. If you use the same strikes, either in call or put, the result will be the same. Okay, so Condor, either with a call or with the put, same strike, same result. Only thing difference between strike 1 and strike 2. The same distance should be between strike 3 and strike 4. Am I making sense? Okay, I answer. What are the Greeks? Delta. What is delta? What is theta? What is gamma? What is vega? Delta is neutral. What is theta? Positive. All these directional strategy, theta is positive. Gamma, negative. Vega, negative. Whether it is a butterfly, whether it is a condor, whether it is an iron condor, these Greeks are going to remain the same. So if I do a condor with a call or a put, result, if the same strikes, the result will be the same. Am I clear? Good. Yes, Kavita ma'am, how are you? How is it going? How has been your revision? Iron condor. Yes, Shubrat sir. How is it going? Yes, Vijay sir. Yes, Joe sir. Kavita ma'am, please take care. I know when a family member is not well, there's a lot of stress. Please take care. Yes, Satish sir. How is it going? Good. Now we come down to iron condor. Limited risk, non-directional strategy. Kavita ma'am, I have great respect for you. Great respect. In fact, this only increases my respect. The fact that in a stressful situation you are in my class shows your commitment. Limited risk, non-directional strategy. Large probability of a small earning. So we did an example yesterday. If I feel that the range of Nifty is between 16,300 and 15,600, we did an iron condor, right? So my average loss will be higher than the average profit. But my probability of being in profit is a lot bigger than the probability of being in a loss, right? -1 OTM call, +1 FAR OTM, -1 OTM put, +1 FAR OTM put. So basically, if Nifty is at 15,800, I feel that 16,300 can be a strong resistance. I'm selling the 16,300 call. And I'm buying the 16,600. 15,500, I'm writing the put and buying the put at 15,200. Right? So if you remember this, bear call spread, if you remember this, bull put spread. So iron condor, my friends, is nothing but a bear call spread and a bull put spread of out of money strikes. So ideally, the risk reward ratio will be favorable when IVP is greater than 65. The risk reward ratio will be favorable when the IVP is greater than 65. Am I making sense? Great. Now we come down to the last of the option strategies. Calendar spreads. Calendar spread, what are we doing? Different expiries, same strike. If my expectation is Nifty is going to close 16,000 on July 1st, so what am I doing? I'm selling July 1st expiry 16,000 call. And on the next expiry, I'm buying the call. Meena ma'am, if the IVP is higher, the better. In this situation, the IVP is lower. Strategy is good, but the risk reward ratio will be poorer compared to when the IVP is higher. Right? So same strike, different expiries. So what will be the Greeks? Delta neutral. Theta, we all know it will be positive. Why? Because the near strike, there will be more time value premium loss. Vega, negative or positive. Who will tell me what will be the Vega? Yes, Meena ma'am, what will be the Vega? What will be the Gamma? Very quickly. Siddharth sir, Vega will be positive or negative? Gamma will be positive or negative? Gamma is negative, Vega is positive. This is the only difference. In a calendar spread, Vega is positive. In a butterfly and other strategies, Vega is negative. This is the only difference. Am I making sense? I answer, the day it remains in your mind before memorizing, that means you have learned option. I answer, the day you don't need to memorize, the day you feel that I think I know this, that day you have learned option. It is something like getting up in the morning and brushing your teeth. Spontaneity. Yeah, Siddharth sir. Calendar spread also to be done near to the expiry, where you expect a range bound movement. But the added feature is, if the other expiry, that means this expiry has an event, you can get the event benefit also. This is one advantage of doing a calendar spread. In the particular strike expiry we are buying, if we get an event, we know that the IV will not decline, right? IV will not decline. Am I making sense? Is this clear? Great. We can get that from a maths teacher. So we can do the same thing with a put. Buying a far month strike put, selling a current month strike put near to the expiry, where I can predict the range where the expiry is going to close. The longer I hold till the expiry, the more benefit will I get. Right? So what is synthetic long? C minus P, call minus put. Same underline, same expiry equals to futures. C minus P minus futures equals to 0. This is called call put parity equation. Right? Call put parity equation. Now, why do we do this equation? Sometimes we have our positions open in the markets, either a long call or a long put or a short call or a short put. Because of liquidity problems, we are not able to square off our profits or losses. We can use this equation to square off our position. And when the liquidity comes back, we can totally eliminate our positions. Am I making sense? So what are the different types of positional strategies? Covered call, buying one lot of futures or the same quantity in cash, selling one lot of call, same expiry, leg 2, limited profit, unlimited losses. This is done by the HNIs, high net worth investors and institution players, so that they can get the benefit of regular monthly income. So for a trader, this is nothing but selling a put. So what is the equation? Future minus call equals to minus put. Call put parity equation. Future minus call equals to minus put. Right? Am I clear? So you have understood this. So in blue chip stocks, where you are bullish for at least 6 months, Blue chip stocks, you know that they are going to go up, right? This is going to be very useful. So this is done by institutions. So they are not worried about the markets going down because they are bullish, right? They are bullish. This is covered call. Now what you have next? Married put. You're buying futures. You're buying a put to limit your downside loss. So when you have a futures contract, this is a future long. When you buy a put, this is your put. When you combine this, your loss gets limited and your profit is unlimited. So what is the equation? Future plus put equals to call, synthetic call. Limited loss, unlimited profits, right? Caller. Combination of a covered call and a married put. I buy one lot of futures, sell one lot of call, buy one lot of put. The strategy allows you to collect premium while protecting against the sharp drop in the price of underlying. So it is something limited loss if the market goes down, limited profit if the market goes up. Something like the bull call spread, right? Congratulations. So if you see here, I've given you a cheat sheet already. Bull call spread, bull put spread, bull call ratio back spread, bear put spread, bear call spread, bear put ratio back spread, right? Butterfly, condor, iron condor, calendar spread. Have you got this in your sheet? If you haven't got there, please let me know. Right? So now, all set. Kuldeep bhai, all set. Great. So let us start this new class. Yeah, we will discuss this, Meena ma'am. Do not worry. This homework was supposed to be done by Kuldeep bhai. Wow, what a journey we have traveled. While writing the story of your life, don't let anyone else hold the pen. Do you remember this slide? You remember this? We started when we started the option. Here we are. Now we are going to do a case study. Revisiting option strategies with Greeks. Now, so Manasda, why don't you make it and share it with us? Manasda will make it and share with us on Wednesday, the cheat sheet. Right? Revisiting option strategies with Greeks. Now you remember we did something called directional strategies and non-directional. The job of an option strategist is to analyze the market's outlay as discussed. You remember these four words: price action, future open interest study, option open interest study, market breadth. Do you remember these? So let us start and do a case study. I will share the sheet with you. Now you can relax. Please feel relaxed. There is nothing which I don't give my students. Now if you see here, this is a small case study we have done. This is 20 by 1 Bollinger Band, right? 20 period 1 Bollinger Band. In this Bollinger Band, can you see when the prices are sustaining outside the Bollinger Band, it is bullish. Upper Bollinger. When they are sustaining outside the lower Bollinger, it is bearish. Okay? So basically any indicator you can use as an indicative tool for deciding the trend. If it is greater than the upper Bollinger, it is bullish. If it is below the lower Bollinger, it is bearish. So I took one standard deviation. So this is standard deviation. So 67% of the times it will be inside. 35% of the times it will be outside. Depends, Rahul sir. Every strategy has its own pros and cons. You cannot compare two strategies together. Every strategy has a certain purpose. That strategy 50 by 7 catches momentum. The Bollinger Band job out there is to just catch the momentum. Here it is to catch the trend. There's a difference, right? So currently what do I see? There is a breakout. Can you see this? Cup and handle pattern breaking out of the neckline. Yes? Can you see this? Can you see it is above the upper Bollinger? Can you see this? Can we say in price action, Kavita ma'am, this is a buy. It has given a breakout above the neckline. It is above the upper Bollinger, right? Now, can we say that this is a breakout buy? It is a breakout of the neckline. So my stop loss should be just around this level, 10,660. Because if it starts trading below 10,660, then possibility are it will give a false breakout. Then possibilities are it will give a false breakout. Are we clear and on the same page, all of us? Okay. Good, Gunjan sir, how are you? What did you have for lunch? The price action suggests if Nifty upside breakout is valid and the breach of 10,680 does not take place, it is bullish. So when you are bullish, Kuldeep sir, what will you do? Bull call spread. You're going to make bull call spread. It's 9 days to expiry. Yeah, Kavita ma'am, we will take that question in the live class. We're going to create a bull call spread. So what will you do? Now you'll go down to the option chain. What do I see? 10,800 highest open interest. Resistance. I know that 10,800 market is going to form some sort of a resistance. So what can I do? Yes, Meena ma'am, what strategy are you going to make? Manasta, Ketki ma'am, welcome. What strategy? What strategy? I am bullish in the market. I feel that the market is taking a resistance. Bull call spread. Lovely, lovely, lovely. So what strikes, Ketki ma'am? Are you going to buy a call and sell a call? Very good. So let us do a bull call spread. What strikes? Very good, Manasda. 10,600, 10,800. Good. Shaikh ma'am, did I teach you that if the particular out of money strike has highest open interest, it will act as a resistance. So I need to sell that strike. Did I teach you that? Because that is going to act as a resistance. So what I'm going to do, since there are 9 days left for the expiry, 2011-2018, 10,800 call has an open interest of 42 lakhs. And the open interest has been rising in the last few days. So what does it suggest? 10,800 is a probable resistance. So the best possible trade in this bullish scenario where the stop loss is near to the entry price, what are you going to do? You're going to buy 10,700 call. You're going to sell 10,800 call. You're going to do a bull call spread. What are you going to do? Bull call spread. You are bullish in the market. You are buying 10,700 call. You are selling 10,800 call. Bull call spread. So before I make a spread, I must always correct check. What is the price? 10,700 call, 100 rupees. So I'm buying, I'm paying this. 10,800 call, 53 rupees. I'm selling this. So what is the net premium I'm paying from my house? 47. What is my maximum loss? 47 into 75. Lot size. What will be my maximum payoff? 100 rupees if it goes to 10,800 and above. So 100 minus 47, 53 into 75. Now my maximum profit is 3986. Maximum loss is 3513. Is it a good trade to take? Is it a good trade? If yes, why? If no, why? Yes, Rahul sir, you are saying why? Yes, why? Okay, Ketki ma'am is saying ratio is not good. Kuldeep sir, what is your opinion? I answer, what is your opinion? Right. So Kuldeep sir, you are enjoying the weather, right? So it is a 1:1 risk reward ratio if I hold till expiry. So if you check here, what are the Greeks? Delta positive, you remember? 0.17. Theta negative, minus 70 paisa. Gamma negative, gamma positive, Vega positive. So the Greeks are almost normal. The theta loss is neutralized. Now tell me, I answer, will you do the trade or not? Okay, what is the objective of doing this trade? Shaikh ma'am, what is the objective of doing this trade? Ketki ma'am, as per the chart, breakout. What is my stop loss? 10,660, right? What is my stop loss? 10,660. So what is the stop loss? What is the current price? 10,720. Someone was asking me, how do I come to know if my stop loss gets triggered? Who was it? So now, my friends, if I bought this strategy, so what is it telling Manasda? If Nifty falls by 60 points, will I cut my trade? Yes, because this is my breakout trade I have taken. If Nifty falls by 60 points, I need to cut my trade. So if the delta is 0.17, for every 1 point, how much will my strategy lose? 17 paisa. Yes or no? For every 1 point fall in Nifty, for every 60 points fall in Nifty, how much will my strategy lose? ₹10 50 paisa. If 1.17 paisa, 10.2. Sorry, Gunjan sir, you are good in maths. 10.2 rupees. So my delta loss is 10.2 rupees. What is my theta loss? Let us assume around 1 rupee. Gamma and Vega, no loss. So I'm losing about 12 rupees in my strategy. 12 points into 750. 75 is the lot size. 900 rupees. So now if my maximum loss is 1000 and if my maximum profit is 4000, how is the strategy now? Why? Because if markets are going to go down, I'm going to cut my trade. Why? Because I bought it in a breakout. If Nifty falls below 10,660, I'm not going to hold this trade. So can you see, Kuldeep bhai, a simple bull call spread? If I keep it with a stop loss of the underline, it can give wonders. Simple 1:1 strategy. I have showed it can give you 4:1. So now do you understand the power of options? Right? So my friends, let me take you to an Excel sheet. I answer. Am I making sense? कुलदीप सर, इसके लिए बोलता हूं सर, रिवाइज करिए. The price of the call 100 rupees, 10,700 you have purchased. 10,800 call you sold. Your net investment is 47 rupees. Now, when your stop loss gets triggered, Nifty falls to 10,660. Your call falls to 100 rupees. Your put falls to 30 rupees from 53. So when I square this, I receive 7 rupees loss. The new value of my strategy falls to 40 rupees. So if I square it off in 40 rupees, what is my loss? 7 to 8 points. I showed you. How? Let us check. What is the delta? That means what is happening if my call falls by 60 rupees, 0.54. What is happening if Nifty falls by 60 points? What will my call fall by 32 rupees? 10,700. Can you see this? What is the delta? 0.54. Yes. If the delta of the call is 0.54, that means for every 1 point fall, it will fall by 54 paisa. For 60 points, how much will it fall? 32 rupees. If the delta of the other call is 0.37. Very good, Siddharth sir. So here I will gain 0.37, right? So for every 60 points fall, I will make 22 rupees. So what is my net fall? 10 rupees loss. I added 2 rupees for theta. So can you see now why my loss is 12 rupees? Is this clear? So 12 into lot size, 915. Am I making sense? Am I making sense? Good. Right. Now let's come down to the new values. So Ketki ma'am, we have assumed it will the stop loss will trigger in the next 2 days. That is why we kept theta at 2 rupees. Right? Because it's a breakout. If the breakout goes falls in the next 2 days, it will fall. Are we clear now? Investment 47 rupees, maximum profit 53 rupees. Are we clear? Any questions? Now when the market falls, this 100 rupees becomes 67 call, as I showed you. This put 53 becomes 30. My premium from 47 falls to 37. So what is my loss? 10 rupees. Are we clear with this? So what is my option? I can book my loss of 800, 900 rupees. I've taken little extra, square off my positions. So I have option of booking my loss, squaring off my position. So that is one of my option. How many of you have heard the word adjustments or repairs? How many of you? Anyone? Only Kuldeep Bhai? No one else? Okay, Ketki ma'am is also heard. Manasda is also heard. Okay. So option repairs or adjustments are change of my existing strategy. Making a new strategy by adding or subtracting positions into my existing trades. So in this case, my friends, what are we? You are into a loss. Can you see this? Right? Now, you have an option of booking the loss. If you don't want to book a loss, you can change your position in a way that your loss from the original position is minimized. So what can you do here? This was your original position, +1, -1. Now you can create a new position, selling 10,800 strike call, buying 10,900 strike call. So when I'm selling a call of 10,800, I'm receiving a premium of 30 rupees. When I am buying a 10,900 call, I am paying a premium of 13 rupees. So what is happening? I am receiving a net credit of 17 rupees. So what was my original investment? 47. What is now my investment reduced by 17 rupees? What is my new investment? 30 rupees. What was my original position? Bull call spread. I created a bear call spread. If I add this position, +1, 10,700, -2, 10,800, +1, 10,900. So from a bull call spread, I have converted into a butterfly. I have made an adjustment. My original position, which was in a loss, I have reduced my costing from 47 to 30 and converted it into a new position of butterfly. So now, my friends, we have two choices, either to square off in a loss or do adjustments. What do you suggest, all of y'all? What do you all suggest? Exactly. Human psychology is such that they don't like booking losses. As long as you are in a trade, even though it is in a loss, you want to do adjustments. My friends, in my original position, I was getting out at a 10 rupees loss. Now I am still after adjustment. What is my loss? 30 rupees. If I go wrong, and if Nifty does not go to 10,800, I'm still going to lose 30 rupees. What was my reason for taking the trade? Breakout. This was my stop loss. My stop loss is already triggered. Why should I keep this trade? Just think. I'm just betting out with a 10 rupees loss. If I want, I can make another entry. What is my purpose of keeping and trying to risk, because my original position is already wrong? Are we thinking on the right direction? So my friends, whenever you are entering with a stop loss of underline, exit. Don't try to do adjustments. If you do adjustments when your original trade purpose is already exited, your stop loss is triggered, there is no point holding the trade. So in the books, they will tell you do adjustments. In the videos, YouTube videos, they will tell you do adjustments. But in reality, always better to exit with a small loss. It will give you a chance to enter again. Am I making sense? So Subrat sir, if I'm telling you to do it, book a loss, then why am I talking about adjustments here? It does not make sense. Why should I have taught you about adjustments? Did not make sense then. Yes. Why? Okay, I answered. Good try. My friends, can adjustments will be done in profits? Let us see. Now if Nifty goes up to 10,780, what will happen? My call will go up from 100 to 145. My put will also go up from 53 to 86. Right? So what is the net value? 54 rupees. Now, I know that there is a resistance here. I know that there is a resistance here. Right? Let's put this at 84. ₹56. Now I have a choice. What should I do? Should I book this 12 rupees and go home? I entered at 47 rupees. This new premium is now 56. 10,700 call has become 140 from 100. Put has become 84 from 53. I'm making 156 rupees. Should I book 12 rupees profit? 1,000 rupees I'm making. Kuldeep sir, should I book and go? Kuldeep sir says yes. So Kuldeep sir, you talked about 1:4 risk reward. Here I'm losing 1,000, making 1,000. When will I make money as a trader? That is why I'm making you think, making you guys think time and again. Yes. Ketki ma'am, good idea, but that will not give us results. What should be done? I know that there is a resistance at 10,800, my friends. Now, can I sell the 10,800 call at 84? Can I buy the 10,900 call at 46? If I do this, if I'm selling the 10,800 call, 84, buying at 46, I'm receiving 38 rupees. What am I receiving? 38. What was my original costing? 47. What will be my new costing? 47 minus 38. 9 rupees. What is my new position? Plus 1, 10,700. Minus 2, 10,800. Minus 1 and minus 1. And plus 1, 10,900. Butterfly. What has happened? I've taken my money out of the table. From 47 rupees, I have booked 38 rupees. And now I'm still in the market with a butterfly. Now I know that even if Nifty goes outside 10,900, my butterfly will be at least 11 to 13 rupees. And if Nifty stays in this range for 2-3 days, my butterfly will become 25 rupees. So what have I done? I have taken money out of the table. At the same time, I have kept a position which is neutral in the market and which can increase my probability of increasing money. So Ketki ma'am, is this better than buying a put? Obviously yes. Why? Because even if on the last day if market closes at 10,800, I can make 100 rupees. And even if it stays near 10,850, I can make 50 rupees. So I've reduced my investment to 9 rupees, which will not be in a loss. Because even if the market goes outside the range, my butterfly will still remain at 11, 12 rupees. So I have my chances of loss has gone. But my probability of making bigger profits still remain. So in options, my friends, the longer you can hold to your trades till the expiry, the longer you can hold your trades to the expiry, the stronger your chances of making bigger profits because of the theta impact. Am I making sense? So my friends, you must learn to do adjustments in profits rather than in losses. Just the opposite of what you are thinking right now. Change your thinking and the results will change. That is what the saying goes. Change your thinking and the results will change. Am I making sense? Great. Welcome to the jungle. So I showed you with a small strategy, 1:1 risk reward. What can you do wonders with options? You can do wonders. If your approach and psychology is correct, it can do wonders. So I showed you one strategy, momentum, yesterday, you remember? Small stop loss, bull call spread. So can you imagine if 1 out of the 4 trades you go right, you're going to make big money. So if you haven't got my strategy, please go through the recording of yesterday. CP trade momentum strategy, trend momentum strategy, right? So generally option repairs are done in cases of losses. So Kavita ma'am, did it work in Deepak Nitrate? It will work in all momentum stocks. Check Venki's, it has worked wonders. So generally option repairs are done in cases of losses. But repairs can be done in case of profit also, which I showed you right now. In the above example, we saw that 10,800 had a formidable open interest of 43 lakhs. And if Nifty went up by 60, 70 points, the bull call spread could have been converted into a condor or a butterfly and net credit. So Aman sir, if the market breaks outside the range, exit your butterfly. I taught you same principle. As long as the market is in your range of 10,800, 900, stay. Right? So the above example showed that if we have created, we could have got a credit. So I showed you in the loss, if you have converted this into a butterfly, you would have got a credit of 17 rupees, right? But still your butterfly you lost 30 rupees in that butterfly, right? The original cost of the butterfly is 30, but if in a profit, you can reduce your cost from 9 rupees to 13 rupees, which we did. So it is recommended that one should enter any strategy with a fixed stop of the underlying, and not having a fixed stop of the underlying can lead to unlimited losses, especially in net credit strategies like short straddles and strangles. Am I making sense? Right. Lovely. Welcome to option adjustments. On Tuesday, the probable trade discussed for educational purposes. We exited the long bull call spread as it went below our stop price of 10,670. A loss of 10 to 7 rupees per contract was incurred. So there was an instance we could have created into a butterfly, but our investment would be 25 to 28 rupees. But as our price action did not support us, it is always better to exit the strategy if the stop loss is triggered. Am I making sense? Are we all on the same page? Yes? Great. Welcome. So if my friend Kuldeep sir says he needs a regular reference of all the strategies, I should give him. So if you see the option strategy conditions, what strategy is to be done when? So point number one, when I know that the direction of the market is up, 4 weeks and above. 4 weeks and above, the time period is remaining. IV percentile is low. Market is giving a range breakout. You remember we did something in the first class? Narrow cluster of 4 to 5 candles. Kuldeep sir, have you remember or have you forgotten? किसी को याद है कि भूल गए सब? छोटा रेंज, मारुबुजो breakout. You remember that? That strategy is going to help you here. 4 weeks and more, low to medium, range breakout. I know my stop loss is at the low. Bank Nifty is giving a very similar strategy. IndusInd Bank, very similar. See the charts. Tomorrow, IndusInd Bank can give a breakout. Stop loss, small, near the range low. I will buy a naked call. I will buy a naked call. When my upside target is met, what will I do? I will create this position into a bull call spread. So I have decided I will only do repairs or reconstruction, change of my strategies only in profit. In loss, I will exit. In loss, I will exit. So I'm going to do a bull call spread in profit. Are you clear with this strategy? Right. Same thing when the trend is down. When there are more than 4 weeks to expiry. IV percentile, low to medium, right now, like that. Low to medium. Range breakout, just the same thing. 3-4 narrow clusters, and there's a breakdown. So here you are entering naked put. Once your target is achieved and you still feel the market can hold, what will you do? You will convert that into a bear put spread. Manas, the stop loss of the underline means stop loss of Nifty, stop loss of Reliance, whichever share you are trading, from there you are going to take out the stop loss. Right? Is this clear? Good. Point number 3, trend is up. So these are the various permutations or combinations you can do when you have 2 to 4 weeks for expiry. IV percentile, medium to high. IV is medium or high. Now there is a range breakout. So it might be 20 days breakout. Stop loss, medium to small to medium. You can do a call butterfly with a bigger spread. So example, currently Nifty is 15,800. It is giving a breakout. You feel that Nifty can go up to 16,200. So you have bought a 15,900 call, sold 16,200 call, bought 16,500. 15,900, sold 16,200, bought 16,500. +1, -2, +1. Right? +1, -2, +1. Now, after a week or so, or 2 weeks, when Nifty reaches 16,200, you feel that now market has entered the range. So what are you going to do? You will reduce the spread. You will take it to 16,000, 16,200, 16,400. So you are booking profits from your original position of 300 points difference. You are now taking to 200 point spread. This is your new position. Did you understand what did we do? When there was a range breakout, 2 to 3 weeks remaining, you created a butterfly, 15,900, 16,200, 16,500. After a week or 10 days, when the market reaches to a resistance zone, what did you do? Your original position, you have changed to the new position. So when you have reduced the wings, you are booking money out of the table. When you have reduced the range, you are booking the range and you are creating a smaller range. Booking profits out of the trade while staying in the trade. Am I clear with this? Any questions? So this is what Kuldeep Bhai was looking from the very beginning, cheat sheet. But if I told him I'm going to give you, he wouldn't have revised whatever little he did. Right? Similarly, downtrend 2 to 4 weeks. Ideally, you can write this 2 to 3 weeks. That is better. Right? IVP medium to high, breakout. Same way, you will create a put butterfly. So if Nifty is 15,800 and you feel Nifty is going to go down, so 15,700, 15,400, 15,100. So you have created a wide spring 300 points butterfly. And when Nifty comes down to 15,400, absolutely, all my strategies, Kuldeep sir, have a limited loss. I don't do unlimited loss strategies at all. In principle, I have made it a rule in my life, no unlimited loss strategy. So as a trader, I have realized the day you have to go to the temple to pray to God to bail you out of your position, you are not doing business. You're not doing business. If you're making a profit into a covered call, you want to make more profits and you are still bullish. If you are holding the naked call, your theta loss will eat you up. That is why you are converting it into a bull call spread. So as a trader, Ketki ma'am, I have seen you have traded and given money in the markets. And I have also traveled that same journey. You have seen a lot of YouTube videos, followed a lot of them, and lost money. If YouTube videos could have made you money, then I think so. The whole world, no one would be going to school. Everybody would have been glued up to YouTube. Unfortunately, YouTube cannot make money for us. That's a hard reality. Absolutely, I answer, you need a discounted broker. You need a discounted broker. So when the market falls, what are you doing? You're reducing the wings. There are many discounted brokers, I answer. Please check. Please check with your fellow traders. They will guide you. 15,700, 15,500, 15,200. Right? I think so. This is perfect. Kavita ma'am, Meena ma'am, this spread is good. If you are feeling that 16,100 is the new spread, so what you can do, then if you can do 15,900, 16,100 and 16,300. So it depends. It depends where you want to go through. What is your view for the expiry? Right? So that I've taught you. In butterfly, where do you expect the markets to take? Right? Good. Are we clear with all these four? It's very simple. You are squaring 15,900. Example. In this case, 15,900 you are not touching. You are squaring of 16,200, buying 16,100. You're squaring 16,500, buying 16,300. You're just squaring off the original position, creating the new position. Right? Good. Good. 5:26 by my watch. Take a 10 minutes break. Come back fresh. 5:36. See you at 5:36 with a cup of tea and a fresh mind. Welcome back. How was your break? How was your break, my friends? Good. Lovely. So Siddharth sir was a latecomer to our class. So Siddharth sir, how is it going? Good. So let us start. Yeah, sir, I know you're a part of a ECT CRTA course. Oh my God, very lengthy. Great. So now let's come down. Direction up, 0 to 2 weeks. IVP medium to high. Range. Now you know that the market is in a range, right? So what does it say? Let's take an example here. I know that Nifty is in a range between 15,950 and 15,500. Now, if the market is standing here and there is about 7 to 8 days for expiry, and you know that the market is not breaking the lower end of the range, so what will you do? You will make a butterfly, 15,800, 15,950, 16,100. When the market reverses and it goes to this part of the range, you will make money. This is called contra trading. When the market is near the range, it goes, breaches the range low, range high, range low, range high. So in the next 4 to 5 weeks, 5 days, when the market goes up and sustains, my butterfly will give me handsome profits. Am I making sense? I don't know whether you have seen this or not. When you are at a range low and the market is not falling, it will go back and retest the range high. Am I making sense? So when you have about 2 weeks left, you are at the range low, you will create a range high butterfly. And in case you have created this and the market is here and you feel that there is a breakout which can take place, you can increase the range of the butterfly also. You can increase the range of the butterfly also, right? If the market is looking for a fresh breakout, so what is it? See, what was the original trade? 15,850, 16,000, 16,150. Now you feel that market can go up. So what are you doing? 15,850. You are increasing this size to 16,100, 16,400. Right? Sorry, 15,850, 16,100, 16,350. If you feel that market is looking like a fresh breakout, you can increase the wings of the butterfly. Always with a specified stop loss. You cannot do anything without a stop loss. Am I clear? But general, what happens? The market comes here only. What did I show you? The market comes here only. It does not generally give a breakout. The range does not break out. It stays here. So this butterfly will give you money, will give you decent profits. Absolutely. If the wings get broken, you have to change the strategy or exit at a profit. Right? Now we come down to the next condition. Downtrend 0 to 2 weeks. Market is in a range. That is the most easiest doing butterflies. Limited loss. So this is the range. Now market is in the range high and you know it is not breaking out. Then it will come down to the range low. So I will create a butterfly here. So if the market comes down in the next 7-10 days, my butterfly will give me money. So in case if the market is likely to go down, I can change my range of the butterfly and expand it. Same principle, opposite direction. If you are in the range high, you have to make the range low butterfly. Right? Same principle. 0 to 2 weeks. Right? Opposite side of the range, you create a butterfly. Now, let's come down. This is the example we did. Right now, uptrend 0 to 2 weeks. IVP low, range breakout. We did that today before we started adjustments. Small stop loss, bull call spread, 10,660 was a stop loss. In profits, convert it into a butterfly or a condor. Remember, we did the same thing today. Same thing for the sell side. Downtrend, 0 to 2 weeks. IVP is low. Range breakout. Stop loss is small. Bear put spread. Butterfly or a condor. Right? Butterfly or a condor. Are we all on the same page till here? Great. So that's sir, I hope I am not doing too much of academics. I have incorporated quite a bit of practical so you don't get bored. Great. Directional, 3 weeks or more. IVP is low, big gap down. You remember? Ratio back spread, maximum 4 trading session. Ratio back spread, maximum 4 trading session, book profits or loss. In a ratio back spread, gap down, no adjustments. Similarly, 3 or more weeks, IVP low, big gap up, stop loss small to medium, put ratio back spread, not more than 3 to 4 trading session, book profits. Book profits, right? So in a ratio back spread, you have not to do any adjustments. You get out of the trade because the theta impact is very high. Now, 3 weeks and above, range low. Yeah. Siddharth sir, you need to see the recording. We have discussed that a big gap up or a big gap down, the market moves in either direction. So when you are doing a back spread, if the market moves in either direction, we are not a loser. But if the market remains there, theta premium will be eaten up. Right? Now, can you see this? IVP, you remember this? IVP greater than 65. Trend is up, range low, bull put spread, out of money strikes, and far -1, OTM, +1, far OTM. So when you are doing a bull put spread, out of money and far out of money, when IVP is greater than 65, no adjustments. After 4 to 5 days or 6 days, you will book profits or losses. I think so. We have discussed this time and again. Same when the trend is down, right? 3 weeks and above. IVP is high, range high resistance. We are selling out of money, buying far out of the money calls. Bear call spread. Book profits or losses, no adjustments. Now let us do non-directional, neutral strategies, 4 weeks and more. Market is in a range. You remember? Short straddle. We discussed this trade yesterday. 16,000. Market is right now at 15,850. We are selling the 16,300 call. We are buying the 16,600 call. Right? And we feel that the support is at 15,500. We are selling the 15,500 put. We are buying the 15,200 put. We have done this trade. Okay. Now if the market is coming here, okay, you are not sure whether the market will come back in this range or go up. You are not sure. What will you do? What can you do? You are not sure. What can you do, sir? So in case if the market goes to 16,100, you feel that the market has a possibility to go up. So what will you do? You will create a 16,400 call +1. You might create 16,700 call -1. You can create a bull call spread along with this position. So this is your first position. This will be your second position. So you can create a bull call spread along with this original position. Right? Now if the market you are confident is in an uptrend, market is going up, you will square off this position and keep this position, and you can convert that into a condor or a butterfly. But if the market falls, then you will square off this position and hold the original position. So till that period of uncertainty is there, you will hold on to both the positions. Once the uncertainty in your mind is clear, that if the market is going to go up, you can hold this, exit this. Right? If you feel no, the market is falling, exit this, hold this. Am I making sense? This is how you do. In options, sometimes there is unclarity or non-clarity for many days. If the clarity is not there for many days, you hold your positions. to hold your positions. Am I making sense? So one position, Ketki ma'am, you have to book loss. But overall, you should be in a profit. You can't help it. One position में loss होगा ही. Because there is uncertainty. It is better to be safe than to be sorry. Good. Right. Making a call, if it is upper strike, making a bear put, you can make a butterfly also, or you can make a bear put spread or a butterfly in the lower strike. Any one. So now event, we have done this long straddle, long strangle. Exit around the event time. I've told you once the event is out, maximum 1 hour. You remember budget. You remember election, budget 20 minutes after the budget, exit. Elections, maximum 1 hour. Right? So when you are in a range neutral, you can do short straddle or a strangle, book profit loss. So I don't suggest short straddle or short strangle for a very simple reason. Overnight, gap up and gap down, it can hit you. So it is always better to do iron condor when you feel the market is in a range. Are we clear with all the strategies? Right? Welcome. Lovely. So congratulations, we have completed most of the program. Now we are going to do Max Pain theory. The term Max Pain, how many of you have heard this word Max Pain theory? Okay, Rahul sir, you look like an experienced trader. The term Max Pain stems from the fact that most traders who buy and hold option contracts until expiration lose money. Most traders who buy and hold contracts until expiration lose money. The theory states that 90% of the option expire worthless. Hence, option writers tend to make money more than the option buyers. Okay, option writers. So let us go down to the option chain first. Let us understand this concept. Very interesting concept. Now, can you see what is the total position in the call side? 4,01,000. Now let us go to in the money call. 9, 13, 23, 10, 2, how much? Around 40,000. So out of the position of 4 lakhs, 40 to 50,000 is in the money call. Rest is all at the money, out of the money. So we all know that in the money call have a higher probability of having intrinsic value on expiry. So what are you seeing? Moment the option is going towards in the money, the writer is squaring off the position. He is trying to write options which are out of the money, where the probability of closing above zero is lower at the end of expiry. You remember delta of out of the money call around 0.2, 0.3. That means lower probability. So what are writers doing? Writers are very smart. Moment an option is going towards in the money, what is he doing? Squaring off his position. Let's go and look at the put side. Total 3,91,000, 8,000, 5,000, just less than 25,000. Total put in the money, less than 25. That means the writer is so smart that it is very true. This statement is very true, that 90% of the options are either at the money or out of the money, which have a lower probability of having intrinsic value premium. Hence, they tend to close at zero. So that is why it is very true that most of the option writers of at the money and out of money strikes will lose money. Do you all agree now? Do you all agree with this point? You remember I told you this, that there are a lot of YouTube videos, they sell out of the money call and put delta 0.20 minus 0.20, and they show, oh my God, look how much PL we are making. They are simple statistics, ma'am. Simple standard deviation, 2 standard deviation. But they don't teach you what to do in case if you are losing money. That is more important, right? They don't teach you stop loss. Very true. So we all know that options are a zero sum game. At one point of time, only one person can make money. Either the option buyers or the option sellers. Both cannot make money. From the above statement, it is very clear, as I showed you, because of the time value premium, that the sellers are the one who are making money. I think so. It is now very clear. There should be no question in your mind. Short straddle, we have seen. Short strangle, we have seen that 65% of the time seller makes money. 35% of the times buyer makes money. Answer, have you completed it? Why do you get so excited, sir? Let us complete. Right. So if the option seller tends to make the maximum money, so what will the seller try to do? The seller would want the markets to be driven to a point which would cause the least amount of loss to the option writers. That means the writer would like to take the market to that particular point where maximum number of option buyers lose money with their option premium expiring at zero. Right? So what will the sellers try to do? They will try to manipulate the price, especially on the last day of the expiry, where they don't have to pay in the payoff to the option buyers. So if such a group exists, then the option writers will make money most of. We know that. We see that during the expiry day, where there is highest open interest, the option writer tries to defend that level so that he doesn't have to pay money to the option buyers. I don't know whether you have seen with that eyes or not. See that expiry day, you will understand. Right? Now, max pain is that point where maximum loss if the market closes during that day on the expiry, maximum loss will happen to the option buyers, and the option writers will have to make the least amount of payment to the option buyer if the market closes on that rate. If we can identify that point where the market will expire, on the expiry date, we know that there is a probability that the option writer will try to defend and close the market on that particular point, right? On that particular point. So now, did you understand why is this called the Max Pain? Absolutely correct, Meena ma'am. At that particular point, you're going to see the maximum loss to the option buyer. Good. Now, how this max pain point is judged? How this max pain point is judged? Let us see. Now, if you see here, my friends, this is the 1st July expiry. If you see here, this is the payout on the base of the open interest that the writer will have to make to the buyer for various call strikes. This will be the payout which the writer will have to make to the put buyers for the various strike. So the combination of the total call and put is added. So if you see here, where is that max pain point? Can you see here? The total pain 81 crores, 65 crores. Where is it? 15,800. Can you see the max pain point? 15,800. The least amount call writer and the put writer of the strike needs to pay 65 crores. So the max pain level right now is 15,800. Does it mean that the market is going to close at 15,800 right now? No. Because this option chain is dynamic. We have discussed this. This keeps on changing. So this max pain level also goes on changing till the expiry date. But as of now, if this trend continues, then at 15,800, if Nifty closes, the option writers will have to make the least payment of 66 crores. Can you see here? All 33, put 32. If it is going down, the put writer premium is increasing, call writer is decreasing. If Nifty is going up, call writer payment is increasing, put writers is decreasing. So now, my friends, we know that till expiry, if this is going to change, then how am I going to trade this? Is this theory having any base? It does have. It does have. What is the base? The base here is when the max pain is shifting, example from 15,800 to 15,900. That means the writer of the call and put both are shifting their position upwards. The writer of the call and put both are shifting their position upwards. that means it is bullish in nature. So when the max pain is shifting upwards from 15,800 to 15,900, it means that the call and the put writers both are shifting their position upwards. That means it is bullish in nature. Similarly, if the max pain decreases from 15,800 to 15,700, that means that both the call and the put writers or the sellers are shifting their position downwards. It means it is bearish in nature. Now, are we all in the same page? So, Kavita ma'am, have I taught you something? Taking the call put ratio, putting in maximum open interest. You know, we can catch this max pain with our equation. We don't need the max pain. We can catch it through our exercise which we are doing. Is it clear? So this, no theory is sacrosanct in nature. Every theory has its own drawback. So with the option chain, the drawback is it continuous changes with price. So you have to be fluid when you are trapping the option chain data. Yeah, Kavita ma'am, if the max pain is 15,800 and on Monday morning you see the max pain has gone up to 15,900. That means the call and the put writers are shifting their position upwards. So that means they believe that the market is settling higher. So it is bullish in nature. So when the max pain is shifting from one level to a next upper level, that means the writers are shifting position upwards. It is bullish. So example, you see highest open in 16,000 call, right? You don't need to check in Quantsup. All of a sudden you see that 16,000 call, writers are squaring off the position. And the highest open interest is in 16,100 call. What is it telling you? What is it telling you? That those people who are writing 16,000 call, they have squared off. Right? Where have they shifted? 16,100. Shifted upwards. Right? Similarly, those people who were writing 15,800 put, highest open interest has shifted to 15,900 put. What is it telling you? Both the call and the put range, has it shifted up? Yes, from 16,800, 16,000. Okay, Kavita ma'am, you need to revise. When the range of the put shifts up, it is bullish. When the range of the call shifts up, it is bullish. That means the call writers are squaring off. So the range is shifting up. So this is what is happening. Max pain is shifting up. It is getting bullish. Are we all on the same page? Similarly, when the range from 15,800, you are seeing that 16,000 call was written. All of a sudden, what are you seeing? 15,900 call being written. What has happened? Call writing shifting down. Absolutely, it depends on the OI. Highest OI. Bearish. Similarly, 15,800 had the highest OI. It has gone down to 15,700. The range has shifted down, both the call and the put. So when the max pain shifts down, that means the sellers are having advantage. That means they are shifting position downwards. It is bearish in nature. Kavita ma'am, use your brains. Don't use data. If it is registered in your brains, you will understand better. Theories are just coming from common sense. This is common sense. Put call ratio, always you have to check. I answer every 20 minutes. You're not checking right now. Put call ratio needs to be checked every 20 minutes. I have told you in that Excel sheet. Every 20 minutes. Highest open interest needs to be checked every 20 minutes. Every day. That is the part of your job. Is this clear now, Kavita ma'am? Is this getting into your head? Right, because it needs to. I don't want you to be bookish. If you wanted the bookish knowledge, you should not have come to me. You could have gone to the YouTube. I want practical people because we are here to make money, not to learn theoretical stuff. Right. Good. So now my friend Kuldeep sir says he's not finding max pain. Kuldeep bhai, don't worry. Go to Google, your best friend, and write max pain in Nifty. And you will get so many sites that you will yourself go crazy. This is niftytrader.in. So here you've got max pain. If I want to check ACC max pain, here I get. So Kuldeep bhai, please don't worry. There are so many sites which are going to give you the max pain. Right? Is this clear? Everyone has max pain. Mostly all of them. Okay, you're talking about SPX. So type max pain and XPX. You will get your answer in Google. Right. Wow. We are about in the finishing touches. So before I end, you must always understand, without the plan, without the rules, you are nowhere. Right? So what are the important rules for trading? Rule number 1, market players should divide their trading capital into 30-40 equal parts. That means in a single trade, I should not lose more than 2 or 3% of my capital. In a single trade, I should not lose more than 2 or 3% of my capital. So you remember we started with this short straddle, Bank Nifty, golden strategy. So Kuldeep bhai, you were in the Nifty webinar also. That Nifty has given super performance. 70 point stop loss, super performance. The 2 trades of Nifty have given 10,000 rupees in 1 week. Right? So you guys will be joining that. Those people who have attended the webinar will be joining that group very soon. I was just waiting for the course to get completed. Right? 30 to 40 equal parts. You should not risk more than 2 to 3% of your capital. So Kuldeep bhai, if this is going higher than 3%, you need to analyze. You are concentrating your portfolio in a single trade, which is not good. You need to diversify. Am I clear with this? Is this clear in your mind? A single trade, if you are putting in more than 4-5% capital, you can become emotional. You might become emotional and not book your losses. And there is where the problem starts. Point number 2, always let your profits run. Very important. So you remember, when we are doing adjustments, what are we doing? We are not booking our profits. We are only taking out our cost of capital. We are letting our profits run. That is why it is very important to do adjustments in profits. Keep your trade going, right? Point number 3, never let profits run into losses. This is one of the biggest problems with people. They assume that they are going to make money. In markets, they are fluid. Never assume anything. You can always be wrong that very second. So one should never let profits run into losses. Point number 4, in a rising markets, there are no resistance. In a rising market, there are no resistance. So don't try to find resistance in the upward market zones that the market will fall. In a falling market, there are no supports. So a lot of people make this mistake. They try to do bottom fishing, and all the newcomers, they do that. That market और कितना गिरेंगे, और कितना गिरेगा, और market गिरते ही जा रहा, right? Markets are always correct at that point of time. So one must never question the market. Make this your golden principle, because my friends, market moves with money, not with emotions. So the guy who is putting in the money in the market knows when to exit. So if he is putting in enough money and the market is moving in that direction, don't question. Market will follow money in that period. Right? Am I clear with this? The next one, control what you can, manage what you cannot. Losses, my friends, are in my hands. I must control losses. If I let losses go out of my hand, as I told you, the day you need to go to the temple to pray to God about your positions which are open in losses, you are out of control. Cut your losses, cut your losses, cut your losses. Profits can never be in your hands. You always need to manage it, as Meena ma'am said, trail. Kavita ma'am said, trail. Or book, take some money out. Right? Last, but the golden principle. Always know your losses before entering the trade. I have written a quote in Twitter that if you do not put your stop loss before taking the trade, you are signing on your death warrant in the market. If you do not put a stop loss after taking a trade, you're signing on your death warrant, because one trade in your lifetime is going to eat away all your profits. One trade in a lifetime is going to eat away of your profit. Let it get hunted, sir. We are here for the long term. एक ट्रेड से क्या होगा सर, हम लोग को तो 10,000 ट्रेड करना है, right? Traders winning formula, average profits into number of winning trades, average losses into number of losing trades. If this is positive, you see, if I'm making an average profit of 50 points and my number of winning trades are 60, how much am I making? 3,000. If my number of losing trades are 40 and I'm losing 40 points in that trade, I'm losing 1,600. I'm still profitable by 1,400 points. Am I making sense? Are we clear? If this formula, if this is positive, at the end of the day, that one trade, profit or loss is not important. These 100 trades, cumulative profit or loss are important, Kuldeep bhai. You are getting emotional with a trade. Let there be spikes. They are a cost of doing business. Okay, so when we started this Bank Nifty golden strategy, we were doing at 920. There were a lot of spikes and our stop loss used to be hit. So what we did, we ignored that 9, 10, 20 time frame. We started doing from 9:30. So when we changed our time, when we changed our strategy, our stop loss hunting reduced drastically. So in the markets, you cannot completely eliminate uncertainty. Uncertainty is the only constant friend you have in the market. You must tighten your defenses, not your attack. If your defenses are strong, you will succeed in the market. Mistake option traders make: lack of trading plan. People don't have a plan. They enter the market without a plan and then they are hopeful that they will make money. Right? Holding naked call and put for a long period, theta loss. They don't understand that. They just keep on holding. Wrong selection of option strikes while taking positions. You buy far out of the money call. Markets are going up, you think you will make money, but the market stops. The market has gone up from what you thought, but your strike price was far out of the money. Wrong selection. You lose money. As most of you said, I'm going to take an option rectification strategy in loss. You are reluctant to book your small loss. That is the reason why it gets into a big loss. Inability of the market players to understand the impact of Greeks, to know the fair value of options. So a lot of people don't know about Greeks. What is delta? What is gamma? What is vega? Right? So you need to understand that. Today Manasda asked me, how will I calculate my stop loss? Through the help of Greeks. Ignoring volatility, ignoring events while you are taking positions. This is a very important point, especially when you are doing stock futures and stock options. In stocks, options are not very dominant factor. Future open interest is a dominant factor in stock options also. So you need to focus on the future open interest to see whether the long build-up, long unwinding, short build-up or short unwinding is taken at important breakout levels. Right? So my friends, now this is dedicated to all of you all. There are 4 outcomes to a trade. Every single trade, there are 4 outcomes. What are the 4 outcomes? Number 1, big profits. So Linda Bradford, she said that about 8 to 10% of my trades, only 8 to 10%, they constitute 80 to 90% of my total profits. So only about 10% of my trades are very big money or big profits. Second, small profits. Any outcome, most of our trades, 30 to 35, 35 to 45%, they are into small profit. So they just constitute 20% of our total profits. Third one, small loss. So they are about 40 to 45%, right? And they contribute to the drawdown of 25% of my total capital. And the last one is a big loss. Now this is the problem. What happens as newcomer, as Kuldeep Bhai says, he's so emotional with his trades. He feels that the world is against him. So he is reluctant to book small losses, which actually leads to big losses. And if you have one or two trades which are going to give you big losses, it will eat away 90% of your profits. Are you understanding? So if you are a professional trader, you got to eliminate this. You got to throw this out. If you can throw this out, even if you are not making this, you will survive in this maze of small profit and small loss. And as you grow and as you gain into experience, you will slowly learn the art of making big profits. Am I making sense? Are we all in the same page? Kuldeep Bhai, I know you are a newcomer. So I know these emotions are there with you. So you need to overcome this. Get out of this big loss quotient. If you can do that, your trading will go on and you will move to a different level. Right? Good. Yeah, you learn with experience, Kavita ma'am. Stage 1, stage 2, stage 3, stage 4 trader. I'll explain it to you right now. Now we come down to the last part of today. Volatility skew and volatility smile. So now let us go down to the option chain. Can you see this? Nifty IV is different for call, each strike different for put. Can you see the out of money IVs? The IVs are higher for put than for call. In general also, IVs of the puts are higher than IVs of the call. Can you see this? Right. So now let us come down. Volatility skew refers to the fact that option with the same underlying asset with different strike price expire at the same time have different implied volatility. Skewness means biasness. I will come to why the biasness towards the put side is more than the biasness towards the call side. Why does the put side have a higher IV than the call side? So my friends, you have to go back to the history to understand this. When options were first traded on an exchange, volatility skew was very different. Most of the time, options that were out of money were traded at a very high IV. Most of the times, options that were out of money was traded at a very high IV, inflated price. That means high IV. In other words, the implied volatility of both call and put out of money strikes were higher compared to the at the money strikes. Both for call is for put. So which led to something called volatility smile. The reason for that, out of money options had low value in monetary terms, in dollar terms, and were more attractive. The speculators always used to think, I'm investing only $1 or $2. If the market goes in my favor, that $1 or $2 can go up to $10 or $20. This was in the US where the options had started. The reward for the writers, if I'm selling a $1 call or a $1 put, the maximum I could have got is only $1. Right? So the sellers were not interested in selling these out of money call and puts. So the buyer used to give a higher premium in the form of higher IVs as they demanded more for speculative purpose. So that is why IVs for out of money call, IVs for out of money put were always higher. Am I making sense? After that, there was a Black Monday, 1987. So this was the curve. Can you see? So this is the volatility curve. This is the strike. This is at the money. This is out of money for call. This is out of money for put. So can you see out of money put, out of money call? This is the underlying price. This is the IV chart. So IV was higher for out of money call and out of money put. So it was something like a IV smile, volatility smile. This was before 1987. Are we clear? I told you the reason. What was the reason? Out of money call and put were very cheap in dollar terms. So sellers were not interested. So the buyer had to pay higher value in dollar terms, which led to higher premium. Now, my friends, 1987 Black Monday. How many of you heard this? How many of you heard this? Anyone? No one? Wow. Okay, so just go into Google and just see that. What happened that day? I think so S&P fell by 27% or 23%. Single day. 23 to 27, any one of the figures. S&P index fell. Out of money put option. All far out of money. All became deep in the money. That means all went up, multiplied. All multiplied. So what happened? People understood market can fall like a cliff. 23% means months of gains was eroded on a single day. Out of money put option. All out of money became deep in the money. So people realized that when the market falls, the put can rise substantially. Lot of portfolio managers who had bought shares in their portfolio understood that they need to buy puts as an insurance against the next big market fall. They need to buy put as an insurance against the next big market fall. This led to increased demand for put. So from that day onwards, the demand for put from portfolio managers increased. So that led to higher IV for puts. Even though today the market is at the all-time high, the IVs of the put have been high. Aman sir, in US there is no circuit. Even if there is a circuit, it is only for 15-20 minutes, unlike India. Right? So that is why, my friends, the put is like an insurance. So the volatility smile replaced with volatility skew, biasness of higher IV towards the put side. Out of money calls became less attractive. Why? Because we know that the market don't rise 20-30% in a single day. But the put found universal respect amongst the portfolio insurance people. The old volatility smile is seldom seen now, and it is replaced by a new graph which is called volatility skew. Can you see this? IVs of the put options are high, and the call option, this is at the money, the call option keeps going, and then IVs of deep out of the money call option goes up. Biasness of out of the money put compared to out of the money call. This is called volatility skew. Am I making sense? So the demand for the call came down. Why? Did you hear the concept covered call? Fund managers who are buying put, they are also selling out of money call. HNIs and fund manager. So that is why, if you see this graph, volatility is noticeably higher in out of money put compared to out of money call. The inverse relation between the stock price and IV is a result of evidence which show that the markets fall much more quickly than they rise. Thereby, currently there exists a number of investors and fund managers who have never want to encounter. So if in the markets, you will have a bull market and a bear market. So you need to be protected to a certain extent by buying puts. So this will always result in higher demand for put and a higher IV. So now did you understand this? Great. So the last slide, very motivational slide. Don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good. The second you do that, you are dead. Paul Tudor Jones. You know, my friends, when we are new to the markets and when we make money, we have a feeling that whatever we will do, the market should respect. That's the biggest blunder. You should be open to change. There will be subtle changes in the market. Not every market will have the same sort of a rally. Each rally will be different. So the keener and the sharper you are able to pick up, the better you will adapt to the new market conditions. Right? Congratulations, all of you all.
Stay foolish. Steve Jobs said that. Always question yourself. Always question the basics. Right? Wow, here we are. So, as said, we have completed this journey. Wow, 27 hours together. So now I want to hear from your words on the mic. How was your 27 hours or last 4 weeks? How did it go? And what are the challenges you are facing? as a trader or as an option analyst? Come on, Mike, all yours. Would love to hear your voice. All yours.
Thank you, Chetan Bhai. That has been an excellent experience. No, there's a lot of learning going. I'm afraid a lot to revise, and I love the course. Thank you very much for your teaching.
Thank you, Kuldeep Bhai. Keep going. Do not worry about losses. Learn to control your losses. Profits will come. Yes. Can we have someone else?
Chetan sir, thank you. Siddharth here. So last 2 days I have joined your classes, and in last 2 days I able to understand the power of options. I was doing mostly in a cash or sometime option sellings when directional markets are going on, but things get clear for the non-directional where exactly we learn here the condor and iron condor, and why iron condor is exactly for non-directional better than strangle and straddle. Those things also get cleared. Thank you for your valuable time, and we will always
We
in
have
touch.
discussed a lot of strategies. Probably you have missed out. We have discussed the money making, short straddle, intraday strategy. If you can go through the live recording, you will be able to understand that strategy well. So if you are a writer, please go through the live recording or come to the live market on Wednesday, where we are going to practice the new strategy we have discussed.
Sure, sir. Sure, I will come.
Thank you, Suraj sir.
Thank you, sir. Thank you.
We have after this WhatsApp group will continue for a month. Then I have a Telegram channel for my option students, where other option students are there. I will send you all the link. So there are people who have become professionals. So I don't need to answer. There are other professional traders who have become masters who can guide you. Right? We will send the link after 15-20 days of the live session.
Hi there. Thank you so much for teaching me about options, because I was very much zero on that. But if you ask me, last 4-5 classes, I was not clear because I was not able to concentrate because of a lot of tensions in the family. I need to go through it again. If I have doubt, I'll come back to you. Other than that, the class.
Please come back to me. Don't worry. If you have a concern, we will definitely put you in the next batch.
Yeah, I was speaking to Agnish about it because my sister-in-law got into accident and in-laws problem and a lot of issues in my family. So 4-5 classes, I was not clear, in fact.
So join the next batch from the start.
That would be really great if you do that for me.
Right. Please connect with Agnish. He will do the needful.
And if you ask about you, sir, believe me, after my college, I had one sir by name Trinavukar. After which, if you ask me, the best teacher, I always say him as my best teacher, and you're the best teacher after him. And thank you so much. I learned lot of things from you, and always be like this. You give me a lot of confidence. One day I want to become like you, as I did you personally.
Thank you, sir. Thank you, ma'am. Thank you. The pleasure is all mine.
Take care, sir. Always do this.
Thank you. Bye-bye. You take care too.
Yeah.
Yes.
Hello.
Yes, I answer. Welcome.
Yeah, good evening. It's a great opportunity. It's a very good opportunity to learn option from you. Previously, I tried option only do the naked call and put buying, but I lost. But I have no idea how to sell the put and call option. I started for trying Bank Nifty option, which you taught us. It's starting to get profit. I hope I will get more profit. Thank you, sir.
Profit and loss are part of the game, I answer. So did you like the class? You were apprehensive before joining. Is your purpose fulfilled?
Yes.
I remember you had contacted me on Twitter.
Yeah.
You had asked me, should I join or not?
Yeah. Thank you.
Okay,
Thank
sir.
you, sir.
Thank you.
And take care of yourself during COVID period.
Thank you, sir. Thank you. All the best. Yes, I would like to hear all your voices.
Sir, this
You've
is
heard
Meena.
all my voices. Hi, Meena ma'am.
Yeah, I personally feel that the point by point explanation of your thing was very much very much informative, so that we can understand very easily when you give point by point explanation. That's what I feel very interesting towards this course. Thanks a lot, sir.
Thank you, Meena ma'am. I heard you have joined the TMP. Welcome to the course.
Yes.
Welcome. Welcome.
Yeah. Thank you, sir.
Thank you. Right. Right. So basically, Kuldeep bhai was saying about this webinar. Actually, what happens, in e-learn markets, there are a number of webinars which I have done. Now, the irony here is I cannot discuss everything or all the webinar concepts in an option class, right? So what we can do for the students here is that the best webinars of mine, the latest webinars, we have collated it together and for our students, we have given a 50% discount. So there is, if you see here, what are the details of the webinars? If you see this, super trending, 590, 590, 1180, 1180. These are the various webinars which are inside. So 1, 2, 3, 4, 4,400 plus 1,000, 5,400, right? So this you will be getting at a discount of 2,950 or 3,000. So about 50% for the students. This is the least we can do. Ideally, we could have given it free, but then we would have to increase the cost price of the program, which is not feasible. Because a lot of people come here for academics, not for trading. So these are all trading-based models and webinars. So those people who are interested, there is a code which is there, no compulsion. So this includes the latest webinar, Bank Nifty short straddles and strangles. This is a scalping strategy. This is a multi-trader. This is a multi-position. Bank Nifty on expiry day. And these are your various webinars, right? So this is where you have. So Kuldeep bhai, I hope I have you. Manish bhai, you have to unmute from your end. Let me just see. Mukesh bhai. Mukesh bhai, please unmute from your end. You can't? Okay, because I've unmuted all. Yeah, Kirti ma'am.
Good evening, sir. Great class, great amount of clarification, and the best importance of stop loss shown. The Bank Nifty strategy which you've given us is really doing well. And generally, I'm the one who gets really emotional with my trades, and I keep on trying to rectify them. The stop loss has really given me a lot of confidence in trading and getting out of the trade. Basically, I kind of marry each and every trade of mine. So this is really been really helpful. Thank you so much, and great learning in many hours. Great learning. Thank you very much, sir.
Thank you, ma'am. Thank you. Lovely. So it's important these small things when we stop, small mistakes when we rectify. That is why we open the gates of becoming a big trader. So learn how to stop making small mistakes. Once you do that, you will make the winner. Right?
Yes, sir. Yes, sir. Yes, sir. Yes, sir. Thank you. Thank you. Really, thank you.
Thank you, ma'am. Thank you. Great. So you have time to revise. If you all remember, on Wednesday we have a live class. So on the live class, We are going to learn to practice these strategies. So please do your revision. Come back and plan to take at least 7 to 8 trades of different types. Might take some buying trades and might take some selling trades. So just be ready. Just do your revision. That is why 3 days have been given to you all, so that you can come back with a fresh mind. Yes. Anyone else? Hi, Rahul sir.
Thank you, sir. Thank you so much. It has been a wonderful session. I think I've gradually graduated from stage 1, slowly graduating to stage 2, but still making mistakes. I think I would have to do revision at least 2-3 times to, absorb all the content that you've taught us. It's very difficult to, get it in these 27 sessions, but I'm trying to, revise it again and again. Hopefully, by revising, I think I'll gradually move towards, better stages as well. Thank you so much for all the, learning that you've given us.
My apologies. I scolded you, sir. So my due apologies, but it was for your benefit. I hope you make the best out of it, sir. My good wishes are all with you.
Thank you, sir. Thank you so much.
Thank you, Rahul bhai. Thank you. Right. Anyone else? Thank you, Aman bhai, for your message. I can understand some people have some mic problems, some difficulties. Don't worry. It's all fine. It's all being a part. You can come back in the live markets and we can have a mic session there. I would love to hear people. That is what is the beauty of life. We all come from different domains, different part of countries, different part of world. We all are meeting here for a common objective. Our objective probably is successful of getting the basic knowledge. Now we need to build upon this as a base to be a successful trader. Success will come. There is no one who can stop you. Only if you start believing and start rectifying. So there is a lot of unlearning which you need to do before you learn back again. So this unlearning process is not only applicable for you or Aman bhai, it is also applicable to me. You all have to unlearn, to learn new things.
Chetan bhai, can I say something? Sorry about that.
Yeah, Kuldeep bhai, please do that.
Yes, I just wanted to add. Basically, I had purchased courses from USA, and their way of teaching is completely different. And it was, for me, it was slightly difficult to initially understand how we were going. So I later on grabbed everything, because it's made a lot easier. Because they show something what they, they want to make money, and they are actually making money by showing only profitable things. They don't show anything because they want to sell their courses. That's what I found. In Yorks, you come out honest, trustful. I loved it, honestly. Thank you.
Lovely, Kuldeep bhai. So nice. So nice. See, what advantage I bring to you on the table is my journey of a loss-making trader to a profitable trader. So there are a lot of things where I can apprehend what you are doing, which I have done as a trader as an earlier part. So I feel compassion with you all, but at the same time, this is my motto of being a trainer when I don't require one, so that you can shorten your learning curve to be profitable as a trader. That is where it's most important. So that's important part of the journey. So there are a lot of people who are teachers and trainers, but they have never been traders. That is the problem. So we will discuss that in the live markets. What you should do. Right? We will discuss that if you require any software or not. So right now, Yeah, Kavita ma'am, can you share your experience of the other institutes, please? So that I can also, I have not been to other institutes, so you can
Sir,
share.
I don't want to name the institute, but yes,
No, I
I
am
am
not asking the name also.
still with one other institute where they are not traders, but they are trainers. Believe me, I do intro calls, and I am very much, news-based trader, as I said in the beginning. And I have seen them the exact way what you said. They don't trade and they give calls. That's it. And I used to wonder how they give calls when they don't take the trade. At least they should take the trade, right? Once in a while. They don't take trades at all.
Correct.
And I paid at least 75K there.
Right.
And believe me, I don't want to go into deep, but I regret for paying that 75K because I didn't learn anything.
Correct.
It's a waste of money, and the conference also didn't get built up there. And I referred 2-3 people also in the beginning. If ever I just should have waited for at least a month or so, then I am sure that I would not have asked them to join there. Anyway,
Okay.
it's a mistake from my side, but anyway, I was not at all happy. But here I felt that I'm sorry, but I've been through a lot of another institute also, because 2-3 institutes I have failed miserably by paying. But this was the big one because the amount was very high. But here I didn't pay much, but I gained more than what I paid. And really, I'm very, very thankful that I chose the right place.
Thank you, ma'am. Thank you, ma'am. See, ma'am, I'm not very popular, and I
You
don't
are,
intend.
you are, because I have a group of, as I said, I run a group. I run a trading group where
Okay.
it's a non-profit group I run, where a lot of ladies are there, people
Right.
from, and I think you should be knowing. I put it in the group also, the WhatsApp group. I run a non-profit group where 48 rare people are there, where a lot of ladies and kids are there from college-going kids. I give only intraday calls. It's my calls. I give the intraday calls, momentum calls, and it works. People earn at least 5K per day. So I'm happy because I'm able to help them.
Lovely, lovely, ma'am. Keep going, ma'am. Keep going, keep going. I'm really very impressed. Lovely,
Thank you.
Mukesh bhai, I'm reading your message. Thank you, ma'am. I am humbled. Since you have been to many places, your experience you have shared, it's humbling. For me, what a little I can do is if I can get you on track to be a winning trader, which you are already. But in options, if you can, I'm successful. So Mukesh bhai is into trading for the past 1 year with continuous learning with different sources. I mostly do cash trading. I never confident, but I firmly believe in position sizing my stop loss. I've learned a lot from you. Your cheating style is something like I like. Giving 25% of your time to revision is very helpful. Thanks a lot. I have seen all your webinars before. I am a CRTA student and aspire to make a career in financial market as a financial advisor and a portfolio manager. I aspire to become like you. Thank you. God bless you. Thank you, Mukesh bhai. Thank you. I am a very small individual teacher, but if you can be a change in the life of people, I think so. The world will be a better place. So when I started teaching, I never believed that this change can happen. But today, when I see at least 50% of my students are making money month on month with proper discipline stop losses, it gives me a lot of confidence when I get up in the morning. Together we can. That's my belief. So I can vouch what I teach. We have experienced it with our own eyes. We have seen that these big stop losses were eliminated, small losses, and we have come into profits. Yeah, we will put that, Kavita ma'am, in the next 10-15 days. We will put you into an option group, not very active, but there are very good traders there. They follow our strategies intraday and iron condors and butterflies. I meanwhile once in a time put on a trade there. Yeah, we make sure that all of you join. Right? That's great. So those people who have taken my nifty webinar, just give me a message with the webinar receipt in my WhatsApp. You will be added to the main Nifty group. So all my students who have done the Nifty webinar, Kuldeep Bhai, Kavita ma'am, all others, please give me a message with your receipt. We'll do that. Yes, Mukesh Bhai, you were also there. Right. Meena ma'am, TMP has 6-7 webinars. Just have a look whether that webinar has it in there. Just see the recording and give me the message. If it has, see the recording and then send me the message. Okay? See the recording first. Right? Those people who have purchased the webinar, send me. Kavita ma'am, Agnish will guide you. He is the one who takes the call. He will put you in the next batch. Just connect with him. Tell him I've told you. Right. Thank you, friends. The journey has just started. I believe it's not ending. Our relationship has just started. Right? This relationship is forever. That's what I believe in. I believe in destiny. I believe that I'm able to meet you not in person but in the course is my good destiny. So let us make the most out of it in this journey of life and markets. So I end with this parting quote. Attitude and choices of today, your attitude and your choice that you make today will be your identity for tomorrow. Will be your identity for tomorrow. You are the master of your destiny. Today, right now, this is your time. Make the most out of it. Build an attitude. Make a choice which might be very tough today, but might clear your path for the future. Don't give up. Keep revising. It might be challenging, but after the challenges will show the light of knowledge, the light of profitability. My friends, let the journey begin. God bless you all. I hope you guys are going to do good revision and come for the live class. And you're always welcome to take your trade with me. Yeah, Kavita ma'am, TMP is trading mentorship program. Right? Meena ma'am can guide you on that. She has joined. So one part of the mentorship program in the training part is option which I've already completed. Oh wow, Shaik ma'am has also joined. Lovely. So you will get better trainers like Mr. Bajaj and Mr. Sauradeep Day in the field of technicals. My part you all have already completed. I will meet you in the live classes. Right? So everyone has their own style. Bajajji has a style on relative strength. Sauradeep sir has his own strategies. So you get to learn the different person perspective towards market and life. I'm just a teacher and a small timer and will be with you all throughout. Whether you are in TMP or EOT or you're not there. Let's make a difference going forward in the lives of people we touch. That's what I ask for you all. Learn to be better versions of yourself. Have a golden heart and life will shine. Right? And life will shine. Right. All are good teachers. Kuldeep Bhai, Abhijit sir is not in the TMP. Right? Thank you all. Bye-bye. See you and meet you in the live session. Take care.